The United States has just printed a new deficit number, and if you have money in the bank, you've got a target on your back. Let me show you why the market always reacts turbulently to this topic and why every investor fears losing money. If you don't know me yet, my name's Chad. I'm the host at Zero Markets, and I want to start this video with something very clear. Every time the United States announces a new deficit number, the market panics. Headlines scream crisis. Analysts talk about collapse, and investors get that feeling this is going to end badly. But let me challenge you right away and bring you a reflection. What if the American deficit isn't exactly the villain you've been told it is? Does it really matter? Or is it more noise than real risk? All right, the American deficit basically means this. The government spends more than it collects. All right, we knew that. So far, nothing new. The US has been running deficits for decades. Yet, the dollar remains strong, and government bonds keep being bought, and Wall Street is still the world's financial center. So here comes the uncomfortable question. Why does the American deficit scare so much? And has it never broken the US? Here's where investors often make a big mistake, looking at huge numbers without the context. Before I organize this reasoning for you, go ahead, like this video so YouTube suggests more relevant content like this, and subscribe to Zero Markets so we have the incentive to keep bringing smart and strategic insights about trading, financial markets, and investments here. All right, let's go. Deficit is not debt. Deficit is the annual flow. Debt is the accumulated stock. The U.S. finances this deficit by issuing treasury bonds, and these bonds are, to this day, considered the risk-free asset of the global financial system. Now, here's the key point. Why does the market accept this? I'm going to give you 3 analyses to help you think clearly. Now, number 1, first of all, the U.S. issues the system's currency. The dollar is the world's primary reserve currency. This gives the U.S. flexibility that no other country has. Second, it's important to understand there is financial demand for U.S. debt. Funds, central banks, insurers, and even governments need liquid, deep, and reliable assets. The U.S. market delivers this like no other does. Finally, and completing our third point, the deficit is also economic policy. In times of crisis, spending more is a choice. It's not a lack of control. That's what happened back in 2008. That's what happened during the pandemic. The problem isn't having a deficit. The problem is losing the ability to finance it with confidence. And that's where investors need to pay attention. So, analyzing the information this way, when does the deficit become a real risk? When interest rates stay structurally high for too long, when economic growth doesn't keep up, when investors demand a higher premium to buy debt, when institutional confidence starts to crumble. Today, the American deficit is a warning. It's not an announced collapse. It's like a high credit card balance. It doesn't break someone who has income credibility and access to credit, but it requires discipline and attention. Do you get the logic of this game, guys? To conclude, does the American deficit matter? Yes, of course it matters, but not in the simplistic way that many headlines sell it. For investors, it's essential and it's strategic to understand when the deficit becomes a systemic risk and when it's just political and media noise. Those who understand the context invest with less emotion. Those who only react to the noise always arrive late. That's it, investor. If this content helped you see the American deficit with more clarity and a little less hysteria, subscribe to Zero Markets to stay on top of market insights in a smart and strategic way. Here, we trade headlines for real scenario analysis. We'll see you in the next video. And please feel free to comment your opinion on this topic and share your comments and suggestions for future videos.